Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 105. And this week, I'm afraid that Richard is off sailing, so you've just got me. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. First, the news. Well, the big news of the week was last Friday, after we'd recorded the weekly, the US non-farm payrolls for January came in, and it came in very hot. So the market was expecting the US economy to have created around 190,000 jobs in January. And according to non-farm payrolls, it created 517,000 jobs. And that led to a big rally in the market as the market came to believe that the US economy was stronger than it had previously thought and that the US was headed for a soft landing. Now, we have a special section coming up on non-farm payrolls, and spoiler alert, not is all it seems. During the week, Jerome Powell gave a speech in which he declared that the disinflationary process has begun, which was reassuring to equity markets. And the FTSE 100 has hit an all-time high. Something I have got wrong. I've been anticipating higher interest rates to cause a recession, which would be bad for equities. And so far, equities have defied that. We also had EU sanctions starting on Russian oil, putting a price cap on Russian oil of $100 a barrel. And elsewhere, we've had a terrible earthquake in Turkey, which currently the death toll is around 20,000, but that continues to rise. Okay, some charts relating to the news. So this is US non-farm payrolls, and it's one of the biggest surprises on record. So the market was shocked by just how strong jobs creation was in January. And we also had the ISM services data for January, which we'll show you in a minute. But again, that was very much a surprise to the upside. And so the two numbers combined convinced the market that the US economy was doing better than it had previously expected. And all that caused the US yield curve to shift up. So the blue line is the current US yield curve. The grey line is the yield curve as of the 1st of January. So you see, after the FOMC meeting at the end of January, the whole yield curve shifted down. And then after the ISM and non-farm payrolls, it shifted massively higher. So the market thinks the Fed will now need to raise rates higher to get inflation under control in the US because the jobs market is tight. And the market now expects US interest rates to peak at 5.25%. This chart shows the performance of the S&P 500 around Jerome Powell's speech earlier in the week. And you'll see that, first of all, took his comments well, then badly, then very well. But the bond market took it badly, leading to a rise in yields. So Powell was hawkish. He said inflation was going to be under control, but they would need to, he reiterated that they would need to raise rates further for longer. In the UK, we had the National Institute for Economic and Social Research come out with a prediction that the UK would avoid recession in 2023, although for many households, it would still feel like a recession. Now, the IMF and the OECD are forecasting that the UK will have a recession this year. And elsewhere, last week, Hindenburg Research came out with this bearish note on the Indian company Adani Enterprises, and its share price has absolutely collapsed. Now, Hindenburg Research has a very good track record. This is a table of the performance of the companies that it has brought out bearish notes on, and you'll see they've generally done very badly. So listen to short sellers. They've done the work. They know generally what they're doing. Okay, and on to this week's economic data. So we had relatively little data this week, so I'm going to go through most of it. So in the EU, we had construction PMIs, and they were better than expected. Expected at 43.1, came in at 46.1, and that was up on December, but still below 50 and still in contraction territory. EU retail sales year on year for December fell to minus 2.8%, down from November and below expectations. The European consumer is not doing well. The UK, we had construction PMIs that came in at 48.4, which was down on December, but above expectations. So UK construction sector is doing better than expected, but still badly. UK retail sales for January came in at 3.9%, well down on December and hitting expectations. Now, the Royal Institute of Chartered Surveyors house price balance for January came in at minus 47. So on balance, far more chartered surveyors were reporting falling house prices than rising house prices. And that was down on December, but slightly better than expectations. In the US, the big number was non-farm payrolls. It was expected at 190,000. It came in at 517,000, well up on December, and portraying a jobs market in the US, which was still creating jobs and still tight. The labor force participation rate ticked up to 62.4%. Average hourly earnings came in on expectation at 4.4% year on year, down on December, which is a reassuring number. We also had the ISM non-manufacturing PMI, and that showed a huge bounce, well above expectations. So in January, it was 55.2, well up on December, and massively beating expectations. Employment hit expectations, coming in at 50, i.e. neutral. New orders bounced enormously and was responsible for the strong PMI. So new orders in January came in at 60.4, well up on December at 45.2, and well up on expectations of only 47. So new orders surged for non-manufacturing companies, according to the ISM in January. Business activity also surged to 60.4, well up on December and massively ahead of expectations. Prices paid came in higher than expectations, although below December. So non-manufacturing companies in the US are seeing slowing prices paid, but the prices they're paying for inputs is not slowing as much as expected. And on some charts. So this is UK S&P Global Construction PMI continuing to drift off and below 50. So construction activity in the UK is slowing. Retail sales year on year had a surge over Christmas, but that surge is now fading. The UK Royal Institute of Chartered Surveyors house price balance is now falling, and it's the lowest level since after the Great Financial Crisis. And UK mortgage rates continue to rise and have now hit 6.6%, and that will slow the housing market further. Moving on to the EU, this is the construction PMI, which had a bit of a bounce in January, but remains below 50. EU retail sales year on year continue to fall. And in the US, we had non-farm payrolls, which bounced enormously in January. And the labour force participation rate ticked up, which is good news. The unemployment rate fell to its lowest level since 1969. We have a section on that coming up. Average hourly earnings faded, which is good news. This is the ISM non-manufacturing PMI, which has been very volatile recently and had a big bounce in January. And the employment survey was flat at 50, neither adding or losing jobs. New orders surged, and business activity surged with new orders. Prices paid continued to drift off, but slowly. The Johnson Red Book Index of US retail sales is declining, and reminder that is based on actual till data. So US retail sales are slowly falling, but surveys of US consumers show that they have become more optimistic about the economy in recent months. This is US 30-year mortgage rate, and that is down from its highs. Now, the mortgage index, which is an index of all mortgages, commercial and private, has bounced up from its lows, but is still showing very low mortgage activity. I've included a description of the mortgage index in the box. Pause and have a read. Initial jobless claims ticked up a bit last week, and continuing jobless claims also ticked up. So in summary, in both the EU and the UK, construction activity bounced slightly in January but remained weak. Retail sales continued to decline. In the US, the non-farm payrolls for January showed very strong jobs growth of plus 517,000, and unemployment fell to 3.4%, its lowest level since May 1969. However, neither of those two numbers is quite what they seem, and we have a section on that coming up. The ISM non-manufacturing PMI bounced hard, coming in at 55.2 in January, thanks to a surge in new orders. And combined, the non-farm payrolls and the ISM portrayed a US economy which was resilient, and implied that the Fed would need to raise rates further for longer to control inflation. Okay, onto one chart. And last week, forward US earnings growth forecasts for the S&P 500 went negative for just the fifth time since 2000. And this chart shows the cream line is forecast earnings 1 year forward for the S&P 500, and they have just gone negative. And the blue line is the S&P 500. And you'll see whenever earnings forecasts go negative, the S&P tends to fall. Sometimes only slightly, such as in 2015, but other times very heavily, such as in 2008 and 2001. It is difficult to see how US equities can continue to rise when earnings are falling. And onto inflation watch. So we only had one new piece of data this week, and that was German inflation for January. And that actually rose from 8.6% in December to 8.7% in January. In the UK, the National Institute for Economic and Social Research is forecasting that UK inflation will peak in January. We're awaiting January inflation numbers, and then start to fall rapidly from February onwards. And in the US, Goldman Sachs are forecasting that US inflation will fall rapidly back to below 3%, but will not reach 2%. You see, it is expecting below 3% inflation by mid-year. And a key driver of that is goods inflation, which Goldman are forecasting will turn negative later in the year. And a key driver of inflation is wage growth, which looks to be decelerating. And there is a strong correlation between wage inflation and PCE inflation, personal consumption expenditure inflation. And now that wage inflation has peaked, hopefully, inflation has also peaked. Although pricing pressure in the service sector in the US continues. So the white line is manufacturing prices, which have fallen back sharply and are now below 50, indicating declining manufacturing prices, whereas services prices have been slower to decline. And that will be a concern for the Fed. Inflation pressures are lingering in the service sector. And this is the Baltic Dry Index, which shows the cost of shipping dry bulk goods around the world. And it is now down below its pre-pandemic levels. And companies and US companies are mentioning inflation less in their earnings calls, which is good. They're less concerned about inflation. But reminder, US interest rates remain far below where they should be under the Taylor rule, and the Taylor rule dictates where interest rates should be in order to get inflation under control and the Fed to meet its 2% inflation mandate. So the US is relying on trends within the economy to bring inflation under control more than monetary policy according to the Taylor rule. So summary, in the UK, the NIESR is forecasting that inflation will actually rise in January and then begin to fall rapidly thereafter. In the US, inflation is now in decline, but the rate at which it declines will be heavily dependent on the services sector and wages. A tight US labor market means that wage inflation will be sticky, and the Fed will then need to raise rates further for longer to create some slack in the labor market and bring inflation down. Okay, on to recession watch. Now, we've talked about this before and how during the pandemic, fiscal and monetary largesse led to consumers having a lot of money, which they're now spending. But one thing we haven't discussed is how actually the increase in consumer wealth in the US was not just, and in fact, not even primarily cash. So if you look at the bars on the left, which shows change in household assets, you'll see the blue bars are change in cash holdings. The green bars are change in US consumer wealth due to their real estate holdings, and that shot up. And then yellow is equities. Now, we know that very low interest rates in the US led to a surge in house prices, which led to a big increase in household wealth. They also had an extraordinary rise in the S&P 500, and that led to big increases in their equity wealth, although that has declined with the market during 2022. But because house prices in the US remain elevated, or they're coming down a bit, US household wealth remains much higher than it was pre-pandemic. And the wealth effect means that consumers will tend to spend a portion of that, which will maintain demand and possibly inflation. The blue line on the left here is the change in household currency and deposits. The other lines are inflation. You'll see the surge in money led to a surge in inflation, but now that surge in household cash is fading and falling. You would hope that the surge in inflation will also peak and fall backwards. But households remain better off currently after adjusting for inflation. This is US real personal consumption. And you see, during the pandemic, there was a huge surge in consumption. And now you'd expect that to slide back towards trend. Now, now we know that US consumers have a lot of cash that they've saved up from the pandemic, but how much that supports consumption depends on its distribution. And we know that the bottom 60% of the US income distribution has now largely spent its excess savings built up during the pandemic, and they are turning to their credit cards to support consumption. So you'll see the savings rate in the US has collapsed to its lowest rate for many years, and credit card loans are surging. So US consumers at the lower end are turning to credit cards to fund expenses. And that coincides with a sharp rise in the interest rate charged on credit cards. So the red dots are the interest rates charged on credit cards, and you'll see that that has surged from below 15% during the pandemic to above 19%. So best part of a 30% increase. And the blue line shows credit card loans. So US consumers are turning to very expensive debt to fund their lifestyles. And a reminder, we've shown you this chart before, but at current rate, the excess savings built up by the US consumers during the pandemic should be exhausted by mid-2023. The reason you're having a surge in inflation in the US is that the US fiscal response was just much larger than most other countries. So as a percentage of GDP, the US spent 25% of GDP on its COVID fiscal response, twice that of the average advanced economy. That has ended up in US consumers' pockets, leading to excess demand and surge in inflation. Now, during the pandemic, there was a moratorium on evictions, but that moratorium has now ended, and the US is starting to tackle the backlog, leading to more evictions. These are evictions filings in one county, and I think California in the US. And you'll see that it's rising rapidly. So poorer households in the US who have been unable to pay their mortgages have been able to live rent-free in properties while the while evictions were not being enforced. Well, now they're being enforced. Turning to the Eurozone, the rise in interest rates is causing a collapse in housing demand. And that should feed through to falling house prices, falling construction activity, and a slowing economy. And if we look at Q4 GDP numbers for the Eurozone, they were positive, but that was entirely due to Ireland, which is a global tax haven. If you exclude Ireland, the rest of the Eurozone actually contracted. And these are Eurozone retail sales, and that's not looking happy. European consumers are feeling the pinch. Everywhere, there's a feeling of optimism, but the bounce in manufacturing PMIs has been really small. Equity markets have surged during January, but manufacturing PMIs ticked up only slightly. The manufacturing sector is still not doing well, and recession probabilities are much higher for later in the year. The global economy is forecast to slow, and we are expecting recession in the US and the UK. And related to that, banks in the US are tightening their lending standards. So the blue line is bank lending standards, and the yellow line is US junk bond default rates. And you'll see that they tend to follow with a lag. So expect more US companies to default in the coming year. And if we break down the tightening of US lending standards, this chart shows the percentage of banks that are increasing the spread they charge on loans to commercial and industrial companies. And that has now turned strongly positive. And this shows the percentage of banks tightening lending standards. So they're both increasing credit spreads and tightening lending standards. And that inevitably will lead to a decline in credit growth later in the year and a rise in delinquency rates. These are consumer loan delinquency rates. Now, a reminder, this is the home price to income ratio, which is pretty much at an all-time high. US housing is unaffordable at these interest rates and prices. And that means US home sales are falling very quickly, even faster than during the Great Financial Crisis, which is the green line. Current decline is red, and very few people think that now is a good time to buy a house in the US. And the dark blue line here is housing starts, which are dropping below completions. So that means that as current building projects are completed, the US construction sector should start to shed jobs. And this is the Morgan Stanley cycle indicator, and it is showing that the US economy has now turned red, i.e. moved into downturn. So in summary, a soft landing is now the consensus, but US consumers' savings buffer from the pandemic is slowly being consumed. The savings rate is near a historic low, and credit card debt is rising despite very high credit card interest rates. All evidence of a stressed consumer in the US. US banks are increasing their lending spreads and increasing lending standards, and that should lead to declining credit growth and rising corporate defaults. The US housing market continues to slow. Okay, and now we have a special section on January non-farm payrolls. Now, reminder, last week in the weekly, we were talking about the ADP numbers, and these are from private payrolls, and they came in soft, showing the US economy created only 106,000 jobs in January. And the Challenger job cuts number surged. So more US companies were announcing layoffs. So we were expecting non-farm payrolls to be disappointing, but they weren't. In fact, they were a huge positive upside. The market was expecting around 190,000 jobs created in the US. It came in at 517,000, one of the biggest surprises in its history. And it wasn't just January. They also revised up their job creation numbers for the previous 5 months. So the brown bars are job creation month on month post revision. The blue bars are pre-revision. You can see they've generally revised up the majority of their previous figures. And after all those revisions, non-farm payrolls for December 2022 were revised upwards by 813,000, an absolutely enormous number. And we previously talked about how the household survey was depicting much lower jobs growth than the establishment survey, i.e. the non-farm payrolls number? Well, the gap between the two numbers has closed due to very strong job creation numbers from the household survey over the past 2 months. So the blue bars are the household survey, the green bars are the establishment survey. And you see the household survey shown a surge in job creation over the last 2 months. And this chart shows the divergence between the household survey and the establishment survey, and those two strong numbers for the household survey have led to the gap between the two closing slightly. And this chart shows employment by sector in the US, and you'll see that the vast majority of sectors have now fully recovered their pre-pandemic employment numbers. So all that paints a picture of very strong employment growth in the US. But if you dig down further into the figures, the numbers are not as strong as they first appear. This chart shows US employment, part-time workers and full-time workers. And the red line is part-time workers, and that has surged over the last year, whereas full-time workers has been stable. So almost all the job creation in the US has been in part-time workers. So according to the headline number of the non-farm payrolls, the US created 517,000 jobs in January. But you look at the actual underlying data, the US actually lost 2.5 million jobs in January. And the difference between the two numbers is the seasonal adjustment. So the headline number is very heavily dependent upon the accuracy of a very large seasonal adjustment. Now, is that seasonal adjustment correct? If we look at the underlying data, this chart shows the light bars are the non-seasonally adjusted numbers. The dark bars are the seasonally adjusted numbers. Now you see that January does tend to see quite a large drop in employment, and compared to January 21 and January 2022, the fall in employment in January 23 was lower than might have been expected. But there's a big difference between the economy losing fewer jobs than expected and it creating jobs. Now, Goldman Sachs are saying they believe that the seasonal factor is overfitted due to unseasonably large falls in employment in January 2022 because of COVID. And so if the Bureau of Labor Statistics is anchoring on an excessively large fall in US jobs last year, it means that it's over adjusting this year. Going back to the earlier chart, you'll see that last year, the fall in jobs was 2.8 million, much higher than in January 2021. And adjusting the January 23 number for an excessively large fall in jobs last year will lead to it overcompensating and depicting a larger rise in US jobs than it should be doing. So the charge is that because the fall in jobs last year was larger because of Omicron, this year, Bureau of Labor Statistics in the US has overcompensated and exaggerated job creation. Now, I've actually downloaded all the data for January job losses since 1940 from the St. Louis Fed. And actually, you can see that 23, and that's the last bar, is low compared to recent years. But there is a big difference between the economy not shedding as many jobs as you might expect and it creating jobs, because other data on job creation in the US is not as good. So we talked about this last time, temporary jobs are actually falling, and that is a sign of recession. Although temporary job numbers did tick up in January, but again, that was seasonally adjusted. Overall, temporary payrolls are now falling, and that's a sign of a slowing job market because temporary workers are the easiest to fire and therefore the first ones to be let go. And historically, there has been a relationship between the changes in US interest rates, which is the grey line, and employment, with employment following changes in interest rates with a lag. So the grey line is the year-on-year change in 5-year Treasury yields, inverted, and the blue lines are employment growth. And you'll see that as interest rates rise, so employment falls with a lag. Reminder, the gap between the household survey and the establishment survey could well be caused by financially stressed US workers holding down more than one job. So that was a lot to get through, but in summary, non-farm payrolls for January showed this job creation of 517,000, despite the actual job creation number being minus 2.5 million. So a lot depends on the seasonal adjustment and whether that is correct. Now, a tight labor market may well have caused US employers to be wary of letting people go, but that is quite different from them creating new jobs. And we're just going to have to see how many of the 2.5 million workers who lost their jobs in January are rehired in February. So a lot depends on the February number. But the other surveys that we look at, such as the ADP and the Challenger job cuts, do not show the US labor market being as tight as the non-farm payroll suggests. Bottom line, non-farm payroll seems a bit too good to be true. And although the US jobs market is tight, we question whether it's getting tighter. Okay, and on to ISM services, which also had a big bounce last month. So in December, it had fallen sharply into contraction territory. In January, it bounced back, and that was entirely due to new orders. And the new orders component showed a huge surge. But there is now this huge divergence between the ISM manufacturing orders and the services orders. So it's showing a big divergence between the manufacturing and services sectors of the economy. Now, we've previously talked about the divergence between the S&P Global Services PMI and the ISM. And the S&P Services is much more consistent in showing the service sector in the US just slowing. Now, it did have a bounce in January, but according to the S&P Global, it remained in contraction territory and the bounce was quite small. So, in summary, the ISM non-manufacturing PMI and the S&P Global, once again, are hugely diverging, with the ISM being much stronger and the S&P showing the services in the US in contraction. Now, of the two, the S&P Global is much more consistent, whereas the ISM is much more volatile. Take your pick. And onto the US unemployment rate. Now, we talked earlier about how US unemployment had fallen to a new cyclical low of 3.4%. Actually 4% before the seasonal adjustment. And that shows an US economy that is doing very well. But low unemployment rate is actually a good predictor of an impending slowdown. This chart shows the correlation between US unemployment rate, and yield curve inversions, which are another forecaster of impending recession. So a low unemployment rate tends to be a predictor of future recession. And you'll see that the unemployment rate, by definition, reaches its low just before a recession. And this is the employment to population ratio for 25 to 54-year-olds for the US. You'll see that the US economy has struggled to maintain employment above 80% for any period of time. Now, why should that be? A low unemployment rate means the US economy is running out of workers. Everyone available to work has a job, and therefore extra work can't get done. So revenue growth should slow, earnings growth should slow, and if companies wish to maintain their earnings growth, they will need to cut costs, i.e. jobs. On to US interest rates and what caused the rise in US interest rates in 2022. So this is the US 10-year yield, and that has risen very sharply. Now, most of you out there will be thinking, well, it's obvious, it's the Fed, and this is US interest rates. And yes, US interest rates have risen very strongly over the period. But this chart shows in black the 10-year bond rate, and the bars show nominal US GDP growth broken down into inflation and real GDP growth. And you'll see there's a strong correlation between the two. Now, Aswath Damodaran of New York University ascribes changes in the 10-year yield to changes in nominal US GDP growth, not the Fed. Now, if he's right, US CPI is falling, PCE inflation is falling and is forecast to be around 4% by the end of the year. And we know that US GDP growth is forecast to be very slow this year. The OECD is forecasting real US GDP growth of only 0.2%. So combination of the two means that US nominal GDP growth is going to fall sharply, and if Mr. Damodaran is right, that means US 10-year yields should also fall back. And onto other charts. This is US M2 money supply growth year on year, and it is falling for the first time since records began in the 1950s. And if inflation is a monetary phenomenon, that means US inflation should start to fall sharply. This is a table showing money supply growth year on year back to 1960. It's the first time it's gone negative. One thing that has been puzzling me recently is the positive correlation between bonds and equities. And you'll see that the correlation is currently strongly positive. Now, what that implies is the market is confident in corporate earnings. If corporate earnings never changed, then equities would behave like bonds, and you'd expect bonds and equities to be highly positively correlated. They only diverge when the outlook for earnings is either strongly positive or negative. And so the strong correlation between the two implies that the markets think that earnings are going to be fairly stable in the coming period. And on to good news. And this chart shows on the left the death rate from accidents and air pollution caused by various energy sources, and on the right, greenhouse emissions. And you'll see the two are actually highly correlated. The most dangerous energy sources are also the most greenhouse gas emitting. So coal is by far the worst, followed by oil, than natural gas. So the energy transmission will not just cut greenhouse gas emissions, it will also cut energy-related accidents and deaths. And you'll notice that nuclear energy is right down at the bottom here. 0.03 deaths per gigawatt hour of electricity compared to 24.6 for coal. Coal mining is inherently very dangerous. And onto equities. Well, in Europe, the all-share and the Euro stocks were both up, but in the US, it was a bad week. The S&P 500 was down 2.3%. The NASDAQ was down 3.4%. So some of the January froth coming out of the market. Hang Seng was down 2.2%. Topics up 0.9%. Bitcoin fell 6.4%. So general picture of some of the early euphoria fading. The US dollar rallied and VIX rose as the S&P 500 fell. In January, equity markets had one of their strongest ever starts to the year, and the S&P 500 has broken through its trend line and is well up from its October lows, supported by record call option buying. But earnings forecasts continue to decline, and year-on-year earnings growth was actually down 20% in Q4, based on generally accepted accounting principles, rather than US companies' own preferred earnings measures, such as adjusted EBITDA, etc. And nominal sales growth has also been falling. It's now up only 6.4% year on year. And Morgan Stanley are forecasting that US earnings growth will turn sharply negative over the rest of the year. So why have equities been rising when earnings expectations have been falling? That seems unsustainable. The black line here is Q1 2023 earnings forecasts, and you'll see they've been steadily declining. But the market doesn't seem to care currently. And we talked last week about equities during the US presidential cycle, and in a pre-election year, January is by far the strongest month, although the next 3 months should also be positive. Tech earnings have actually been falling sharply so far this year and have fallen much faster than other sectors of the S&P 500. Equity market froth at the start of the year has forced up the share prices of all the crap, and this is Carvana, whose shares have trebled since the start of the year, although the rally seems to be fading now. But US CEOs are doing their absolute best to support their share prices and have authorized a record volume of share buybacks, treble last year at 131 billion onto commodities and energy commodities. Well, it was a good week for oil. Brent was up 4.5%, WTI up 4.0%. Dutch natural gas futures continued to drift off, down 4.6%. UK natural gas futures also fell, down 8.4%, and that is very good news for inflation in Europe. US natural gas futures were steady, but reminder, they're down 45% on the year. Coal continued to fall, down 44% on the year, and following natural gas lower. Uranium fell 1.4% on the week. On to some numbers specific for the oil market. Well, we're continuing to see builds in US oil inventories, which is bearish for oil prices and implies that the US oil market is well supplied. US crude production ticked up by 100,000 barrels a day last month to a new high for this cycle of 12.3 million barrels a day. But the Baker Hughes rig count fell by a further 10 and is down 22 year to date. So that implies shale patch is cutting back on activity, which should reduce oil production later in the year and tighten the market. This is Brent, had a bounce last week. Non-OPEC oil production is doing well. So the blue dot circled in red on the left here is January non-OPEC oil production, and it's doing well towards the top of its range over the last 5 years. And it's been helped by Russian oil production, which has been resilient. Sanctions are not curtailing Russian oil production. And if we look at Russian seaborne exports, well, they're holding up very well. Exports to Northern Europe have all but disappeared to be replaced by exports to Asia. And a lot of it is going now to India, who are refining it and then selling the refined products to the West. So sanctions just are failing to curtail Russian oil production. Turning out to China, well, there's been a great deal of optimism for the oil price based on the reopening of China, but Goldman Sachs are not actually forecasting big increases in Chinese oil demand. So the Goldman Sachs nowcast for the start of this year is not showing big improvements in Chinese oil consumption. And this is US oil production, and it shows that actually conventional production peaked a long time ago and has been in steady decline as the peak oilers correctly forecast. But total production has surged because of shale, and shale is now the majority of US oil production. But production from shale oil wells declines very quickly, and US oil production was now dependent on continued shale drilling. Reminder, and thank you to Jaw It for sending me this chart. The blue bar on the left is current oil industry exploration and production expenditure, and you'll see that it is compatible with net zero carbon emissions by 2050. But if we continue to use hydrocarbons at anywhere near our historic rate or current rate, then we're just not investing enough to keep up oil production, and that implies a tight market going forward. I thought this was interesting. This is the units outstanding in the US oil ETF, and you'll see they've collapsed over the course of the last few years. So US retail investors have been giving up on the oil industry. Okay, this is European natural gas futures, well down from their peak and continuing to decline, although that is all good news. And the same for UK. US natural gas futures, are they finding a bottom at roughly a quarter of their peak price from earlier in the year? Extraordinary. And the reason that US natural gas prices have collapsed is that you're seeing continued growth in US shale gas production, and those are the blue bars, although the rate of growth is declining. But this year, the US will produce an extra 2.4 billion cubic feet of natural gas. Who is going to consume it when there are no new LNG export facilities coming on this year? Hence, concerns about glut and full storage in the US, leading to low prices. So this is the coal price. It has collapsed following natural gas prices down. Now, earlier in the year, coal was holding up very well, and I warned that it was likely to follow natural gas lower. Well, it has done. This is uranium, which is stable. On to industrial commodities, and generally we are seeing a bit of a fade in the New Year optimism. So aluminium was down 3.8%, cobalt down 6.6%, copper down 1%, nickel down 2.2%, tin down 4%, zinc down 6%. Only neodymium and ferrovanadium managed a rise. This is aluminium fading, cobalt still falling, copper off its recent highs, and there are currently anti-government protests in Peru, which is the world's largest copper producer. But so far, the mines have continued working. That could yet change. There's chromium, iron ore, lithium, well down from its highs, neodymium, grinding slowly higher, nickel. Now, this is reported in the FT today that Trafigura have taken a $577 million hit from fraud. They have been buying nickel from an Indian producer, and then when the nickel has arrived at port, they have discovered that their shipment contains something, but it doesn't contain nickel. So the commodities industry still remains dependent on this network of small, dodgy trading companies feeding into the commodity majors, and fraud is still a problem. This is tin, ferrovanadium, grinding higher following the iron price. Last week, we talked about how carbon black, which is a byproduct of the oil refining industry, contains a lot of vanadium. And I asked anyone if they knew of a company that was attempting to extract vanadium from carbon black. And Genco, thank you, got in touch and suggested Advanced Metallurgical Group, which is listed in Europe as AMG, and this is their share price. And they don't extract vanadium from carbon black. What they do is they recycle the catalysts used by the oil refinery when they have become poisoned by vanadium. So they extract the vanadium from spent catalysts. But their main business is lithium, and they've been doing incredibly well. So as the lithium price has risen, so their earnings have gone from $14.1 million in Q3 2020 to 102 in 2022. In 2 years, that is an enormous increase. And one of the things they're promoting is this hybrid battery storage system, which uses both lithium-ion batteries and vanadium redox flow batteries. And they're the only company to do this. Pause and have a read if you're interested. So AMG looks interesting. It has both exposure to lithium and to vanadium. Have a look. Thank you to Genco for that suggestion. This is zinc. And on to precious metals, and generally a very poor week. So gold was down 2.4%, although it remains up 2.5% year to date. Silver was down 5.4% and is down 7% year to date. Platinum had a terrible week, down 6.4%, down 10% year to date. Rhodium down a bit, palladium down 3.9%, down 9.5% year to date. So only gold is up on the year, and the other precious metals are having a bad time as interest rates rise. So this is gold, well down from its recent peak, silver fading again. Platinum drifting off. Rhodium steadily declining. Palladium also steadily declining. And onto rates. And it was a terrible week in the rates market as renewed optimism about the world economy led to expectations that rates would have to rise higher for longer. So the UK 2-year rose by an enormous 34 basis points, the 50-year by 17 basis points. In Europe, yields also rose, though not as much as in the UK. Now, this chart shows in black speculative positioning by asset managers, and you'll see that they are very long. Now, the previous times they have been very long, yields have tended to fall, and that's the top chart. So they've tended to be right. Will they be right again this time? Now, one of the puzzles is that credit markets are very optimistic. So the yield spread between corporate bonds and US Treasuries is incredibly low. So either you could read that as the market being very optimistic about corporate earnings, and so they don't think there's going to be defaults, or they're concerned about US Treasuries and the possibility of a US default due to the debt ceiling negotiations. So they're now saying that corporate bonds are pretty much as safe as US Treasuries. And blue chips actually pay less to borrow than the US government, which seems totally irrational, unless you think that the debt negotiations are going to go to the wire, leading to the possibility of a US default. And that would be catastrophic for financial markets of all kinds. But the US 2-year, 10-year inversion has deepened, so the bond market is saying that there's going to be a recession in the US. And this inversion has been both deep and long by historic standards. Yes, this is UK 10-year rising again, depressingly. UK 30-year also rising again. US 10-year has risen sharply following the non-farm payrolls. The German 10-year also rising as optimism returns, and Christine Lagarde has made some hawkish statements. What's interesting is that the German 10-year has risen more than the Italian 10-year. So the markets are relaxed about the possibility of a Eurozone crisis. Greek 10-year also fairly stable. No change to our views on the asset classes this week. And concluding comments. Well, the market once again believes in a soft landing. Equities have had an astonishing start to the year, and bond yields have risen as strong economic data in the US has led to expectations that rates will have to rise higher for longer to get inflation under control. But the US non-farm payrolls and the ISM may have painted a misleadingly positive picture of the current state of the US economy. All the other data is less strong, and we still believe a recession is likely in the second half of the year. And on to my personal performance. Well, I had a terrible week. I was down 2.7%, which takes me to only up 1.6% on the year, underperforming Richard, underperforming the all share, and generally having a bit of a tough time. As regular viewers will know, I've been predicting a recession for quite a long time now, and I still think it's coming. It's just taking a long time to get here. In the meantime, bond yields have risen, and my portfolio is struggling. It is a problem with making these big macro calls. Sometimes they take a long time to arrive, and sometimes you may be wrong. Well, I may be wrong. I don't think I am, but the market currently disagrees with me. No sells, no buys. This is the 2024 index-linked gilt, and that seems to have stabilized. And reminder, I think that is a good short-term yield bet, in that any gains you get on the index-linked gilt over the course of the next year will be capital gains tax-free, and it's a good place to put your cash. The US Treasury 20-year plus ETF had a bad week as yields rose on economic optimism, and the 2071 gilt, where I have a large holding, is drifting off and is back at its recent lows. Not good for me. Okay, that's it. Hopefully next week Richard will be back and a normal service will resume. But in the meantime, thank you for watching through to the end. Please can you press like and subscribe to the channel. And it is goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.